Last week, the finance minister announced an additional tax on REITs or real estate investment trusts.
One asset class that we don't talk about so often in the real estate space is REITs.
Real estate investment trusts or REITs is the next sunrise opportunity for the real estate sector, given its potential to raise billions of dollars for the cash-strapped industry.
So REITs are basically, corporations that would own, operate and finance the income-producing real estate.
Arguably the best product innovation of the last couple of decades from SEBI is arguably the REITs and the InVITS product.
Hi everybody, on 11th of April 2023, the National Stock Exchange added a special index to its charts, which is a big leap into the real estate sector of India. And while some of you might think real estate requires a huge capital of 25 lakhs to 1 crore rupees, the fun fact is that today you could invest in real estate with as little as 10,000 rupees. And with just this amount, you could achieve the dual benefit of consistent rental cash flow and capital appreciation. This is because of two special investment instruments called the REIT and InVITS. So in today's case study, let's try to understand what are REITs and InVITs and how do they exactly work out, what is NSE's REITs and InVITs index, what are the benefits and risks of investing in these instruments, and most importantly, what are the study materials to help you understand this investment instrument better. But before we move on, I want to quickly tell you about our partners of today's episode, and that is GoSats. People, investing in Bitcoin can be risky, but if you get free Bitcoin rewards, then that is no risk at all, right? Well, meet India's first Bitcoin rewarding platform, GoSats. GoSats help you to passively invest in Bitcoin every time you make a payment. And just like REIT, another asset class that we don't often talk about is Bitcoin, and that too because it's risky. But GoSats have made investing in Bitcoin extremely easy for ordinary people like you and me, and that too in a risk-free and seamless manner. The question is, how? So here's how the GoSats prepaid card works. You load money onto the prepaid card and then spend it like any other card. But here, with every spend about 200 rupees, you earn 1.5% worth of Bitcoin as rewards. But that's not all. Just like REITs, here rewards come with dual benefit. Number one, as I mentioned, you earn money every time you complete a transaction. Number two, you get to enjoy the appreciation in your value of your rewards as Bitcoin goes up in value. And if it doesn't go up in value or if it crashes, then you don't lose anything because this was after all free reward for you. So if this sounds interesting to you and if you're a crypto enthusiast, go ahead and book India's first Bitcoin rewards card right now. And the first 1,000 users to click the link will get 100% of the card purchase amount back in the card. All you have to do is use my referral code thinkschool while signing up to avail the offer. To understand this new index, let's first try to understand the concept of REITs and InVITs. People, REITs is real estate investment trust, and they are like a basket of properties that you can invest in without buying actual buildings. And this could include apartments, office buildings, industrial parks, shopping centers, or even hotels. So let's use a story to understand how do these REITs work and make money for their investors. Let's take the example of Nexus Malls, which is a company backed by Blackstone Group, and it is headed by Dalip Sehgal, who has a 40-year experience in consumer sector. And now they have decided to launch a real estate investment trust. This is because their pre and post-COVID performance have been great. This Nexus Select REIT is focused on acquiring, developing and managing a diverse selection of shopping malls all across the country. Now, had they done this venture privately, all they would have is 100 crore rupees, even though they know how to invest 1000 crore rupees. At the same time, for people like you and me, we would have no way to invest in real estate because of the high capital requirement. But this is where Nexus Select REIT comes out with a win-win strategy. What they do is, just like a company goes IPO, Nexus will go public to raise money from investors like you and me. In fact, Nexus Select Trust REIT is actually about to go public by offering REITs through an IPO. And they aim to raise 3,200 crores with 1,400 crores from primary sales. So at the time of this IPO, Nexus Select Trust REIT owns 17 shopping malls across 14 cities with a market cap of 15,150 crores. And now they want to expand further. This is where the second phase of REIT starts, and that is cash flow and investor returns. So here's a breakdown of how Nexus Select REIT would potentially generate income and distribute it to its shareholders. Firstly, the shopping malls are rented out to giant brands like Zara, H&M, Shoppers Stop, Mango and Cinepolis. So if 1400 crores worth of malls are bought and the indicative dividend yield says 8.25%, this means 8.25% of its investment amount is expected to be distributed to the shareholders. To give you a contrived example of the same, let's say the malls generate 165.5 crores in rent. Then they would incur operating and non-operating expenses such as property management, maintenance and taxes. So let's say the operating and non-operating expenses incurred while running these malls is about 40 crores. So the total profit is 165.5 crores minus 40 crores, which is 125.5 crores. On top of that, they might keep another 4 crores aside for future expansion. So what is left would be 121.5 crores. This is where the third phase comes in, which is profit distribution to shareholders. Now, according to regulations, Nexus Malls REIT is required to mandatorily distribute at least 90% of its net distributable cash flow to its unit holders as dividends. In this case, this net distributable cash flow is 125.5 crores minus 4 crores, which is about 121.5 crores. So let's say Nexus chose to distribute 95% of its net distributable cash flow. In this case, they would distribute 95% of 121.5 crores, which is 115.5 crores to its investors. So if you see, a 115.5 crore return on 1400 crores of capital is a return of 8.25%, which is the indicative dividend yield of the REIT. And from here onwards, as the rent of the properties keeps on increasing, the profits will increase. Eventually, the distributable cash flow to investors will also increase. So the indicative yield might go from 8.25% to 8.3% to 8.4% the next year. So if this macro perspective is very, very clear to you, let's now look at how an individual investor will profit from this REIT. So let's say this 1400 crores that Nexus raised is raised via 14 lakh shares with each unit costing 10,000 rupees. So let's say an investor named Ansh Mehra purchased 10 units of the Nexus Select Trust REIT during the IPO. So he would invest a total of 10,000 into 10, which is 1 lakh rupees. So as a unit holder, Ansh would receive an annual dividend from the net distributable cash flow. So if 115.5 crores are being distributed to 14 lakh shares, Ansh would receive a total of 115.5 crores divided by 14 lakh shares, which is 825 rupees per share. So if Ansh owns 10 shares, he would get 825 rupees into 10, which is 8,250 rupees. This is the indicative dividend yield of 8.25%. Now, does Ansh Mehra's income stop over here? Well, not really. This is where the second benefit of REIT comes in, whereby over the years, as Nexus Select REIT continues to expand its portfolio, it will keep on enhancing its properties, which will lead to increase in rental income, and even the properties will appreciate individually in value. As a result, the share price of this REIT is expected to appreciate even further, which will provide Ansh Mehra with potential gains and consistent cash flow. This is how, through the Nexus Select REIT, Ansh Mehra and other investors will get to invest in real estate market without buying a single property themselves. This is the first concept of our episode. The second concept is even more interesting, and that is something called InVITs, or Infrastructure Investment Trusts. Now, InVITs are very, very similar to REITs, but instead of malls, InVITs help you invest in infrastructure projects that generate regular income. And these projects could be roads, power transmission lines, highways, or even airports. Now, the question over here is, power transmission lines and highways do not generate rental income, right? Then the question is, how do these InVITs actually make money for their investors? So let's quickly understand the income sources of each of these projects individually. Number one, for highways, it's quite obvious. They earn income from the tolls collected from the users of the highway. Number two, for renewable energy projects, they earn income from the lease rentals paid by the project developers. Number three, for solar power transmission projects, InVITs earn income from the power purchase agreements signed with various power generation companies. Then for airports, it's the rent paid by the airlines and other companies that sell or advertise projects at the airport. And lastly, for the telecom tower assets, InVITs can earn from the broadband subscription fees. And just like REITs, the net income of the InVITs are also calculated by subtracting the operating expenses from the project income, and then at last, 90% of its taxable income is supposed to be distributed to the unit holders as dividends. And again, just like REIT, if the distributable income generated is 100 crores with 1 crore shares floating, 90% of the income will be given to the shareholders, which accounts for 90 crore rupees. So if you look at the net return per share, it is 90 crore rupees divided by 1 crore shares, which is 90 rupees per share for that particular year. This is how REITs and InVITs actually work. So now that the concept of REITs and InVITs is very, very clear to you, let's understand the importance of REIT index on the National Stock Exchange. People just like Nifty, which is a group of 50 biggest and most popular stocks in India, there are also indices for specific industries like technology, banking and healthcare. For example, the Nifty IT tracks the performance of the top 10 IT companies listed on the NSE. So in this context, on 11th of April 2023, the NSE created a new index for REITs and InVITs. So now you can track the performance of REITs and InVITs market just like IT and healthcare sectors in the market. And as more and more InVITs are listed on the stock exchange, the Nifty InVITs index will provide valuable insights to the investors about the overall performance of the sector. And the NSE will review and rebalance the index on a quarterly basis to make sure that none of the InVITs actually overweigh upon the index. And this brings us to the last question. What are the benefits of investing in these investment instruments, and why would anyone choose an REIT over an FD or equity? Now, mind you people, regardless of what other people tell you, there is never an absolute answer as to why you should choose one investment instrument over the other. It is always relative to your financial condition, your risk appetite, and your goals in life. So remember, these are general benefits and always filter them through your context while understanding them better. If this is very, very clear to you, let me bring to you the most credible finance creator I know, Sushant Bindal, to help you understand the benefits of REITs.
Sir, when we talk about investments, the first thing which comes to our mind is safety of our investments. Now, when we talk about safety and REITs, in REITs, we are safe because experienced professionals are taking all the major decisions on the behalf of REIT as well as the shareholders as property acquisitions and all the other major decisions. Now, the second rule which helps us in the safety criteria is the 90% rule, which we mentioned earlier, because the market regulator mandates the REIT to distribute 90% of the taxable surplus among the shareholders. Whenever we talk about real estate, we consider it as the most illiquid investment out there. But REITs solve that because we can trade that on the index. So it solves the liquidity problem also. Also, it ensures that we can invest in real estate, which we could not because of significant capital requirement and the illiquidity. On top of that, diversification is a very major benefit. As soon as we add real estate to any investor's portfolio, it becomes significantly better because of this significant correlation between real estate to equity indices as well as bond index returns. So REIT is a very attractive investment, right? But there are some risks involved too. The first significant one is the market risk. So due to the market cycles, the value of the property and the market value of the real estate, it might decrease, which will have a direct impact on the REIT. So our investment also might decrease. The second risk is the interest risk. As soon as the borrowing cost of the company goes up, especially in the case of real estate company, it becomes very difficult for them to make profits out of it, which will directly impact our portfolio of REITs with that real estate company. The third risk is the leverage risk. So REITs use borrowed money to finance their operation. So if the debt becomes huge and they're not able to pay it back, it adversely affects the operations and eventually can lead to a loss in our REIT investment. So these are the risks you need to take in consideration before investing in REITs.
That's all from our side for today, guys. Now you may have a look at all the study materials attached in the description. If you learned something valuable, please make sure to hit the like button in order to make YouTube Baba happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye-bye.